From Barangaroo Studios, the ausbiz COB is the key stuff you need to know about the day in business and finance.
Welcome to the COB. I'm Juliette Sarli. This Tuesday, of course, some people had a public holiday yesterday, but the markets have been open. It is definitely still a Tuesday, and today we are down by about 0.25% on the close. Now, we're pretty flat on the open. We had a bit of a spike coming through when the RBA minutes were released, and then, of course, China came back online, mainland Chinese markets, for the first time since the Golden Week holiday. And look, there's been a little bit of selling coming through, quite a bit of selling coming through in Hong Kong, Chinese stocks in Hong Kong, because the hopes of more stimulus, another bazooka, I guess, from authorities really haven't happened. Shanghai Composite opened higher by more than 10%, but closed the morning session just 5% higher. So a bit of disappointment from the NDRC briefing, and the Hang Seng was down by as much as 10% in the morning, closing down 5.6%. But you can also attribute that potentially to money going out of the Hong Kong markets and into the mainland stocks. Let's have a look at our three themes, for the day. We also had the RBA's minutes today. The RBA vigilance, of course, we know that they kept rates on hold last month. What I thought was interesting from these minutes was that they were perhaps a little bit more dovish than what we even heard in the press conference. They did indicate that they had considered a cut if there was that need or weakness in the economy. Of course, they've always told us they're not ruling anything in or out, but they did allude to the fact that they're watching very closely how the economy is faring. And I was speaking to Maddie Dunk from ANZ, and she certainly thought as well that there was perhaps a little bit of a pivot in language there. Rising confidence. Meanwhile, we had consumer confidence out today at its highest level since the tightening cycle began 2.5 years ago. And I mentioned China underwhelming, perhaps a little bit too much expectation of another bazooka moment from authorities, at least according to Christina Chang, who I was talking to from Citi earlier. She still does expect that there will be a lot more support coming through from authorities, but perhaps in piecemeal announcements rather than one big announcement that really could have lifted markets today. So let's have a look at China exposed stocks on our market. You've certainly seen some weakness coming through in the iron ore players. We don't have the correct read there on Rio, but I will get it for you. And I think that was mea culpa for putting in the London listed stock. But Rio on our market is down 0.75%, $120.38. Fortescue falling as we see a turnaround again in these iron ore futures. Treasury wine estates, though, looking good. Of course, that is very exposed to the China market, as is A2 milk, down 0.6%. Also, having a look at energy stocks, we woke up overnight to news that Brent had touched $80, the first time since August. Of course, it is the 1-year anniversary of the escalation or the start, of course, of that Israel-Gaza conflict. There is a lot of concern about whether or not you could see Israel target Iranian oil facilities. If that happens, it could disrupt the global oil supply, although OPEC says it has enough to rebalance that. Woodside Energy shares down 1.7% today. And then gold took a bit of a tumble overnight as well. I'm not sure if we've got the gold stocks there, but we did see a little bit of momentum as traders scaled back, I guess, these expectations of a rate cut from the Fed in terms of a jumbo cut. Let's get his views, though. Welcome to the COB, Mutton Crab from Shaw & Partners. Don't really know where to start. There's so much going on. Maybe we start with what we saw with China, because there wasn't maybe we just had too much expectation here.
Yeah, I think the market got a little bit carried away with what they thought would be announced this morning or this afternoon. So the Hang Seng, I was looking at this because, how's the Chinese market gone up 10 and the Hang Seng's gone down 10? Isn't Hong Kong part of China? Like, what's going on here? But obviously the Hang Seng was open all last week and actually was up 9.5% last week during Golden Week. So a little bit of what we saw from the Chinese market was just catching up to where the Hang Seng was. But the fact that we didn't get another bazooka, we were expecting bazooka number 2. So the first bazooka got fired, if you like, a few weeks ago, which was more monetary stimulus. We're expecting the fiscal bazooka today, and we just didn't get it. Growth stable. It's going to be around 5. It's like nothing to see here. So iron ore, I think, which was 114, went below 110, which is why we saw the sell-off in those iron ore stocks.
Yeah.
But the Hang Seng had set a pretty tough pace for the A shares market to catch up to. And as you said, Juliette, opened up 10 and sort of was trading up 5. So I just didn't get as carried away with the euphoria. So just like these markets, they're like casinos, aren't they?
Yeah.
And even the Japanese market is moving 10% a day. So they're, not for the faint-hearted, these Asian markets.
Actually, we had another guest saying that earlier, because I think Bank of America and Goldman Sachs coming out with these big calls. Goldman saying you've seen another 20% rally in Chinese stocks. One of our guests was saying you see that in a day.
Yeah.
As you say, there's big moves. All right, let's get back to our economy. So the RBA minutes you're saying shows that the economy is robust.
Yeah, I think your analysis of the language is probably right. I think if you look at the language, it sort of says a little bit more dovish, but the market's taken the whole thing to be hawkish. So if you look at the cash futures, I don't know if you've got the chart that you can show viewers, but the expectations for rate cuts has been pushed out. We saw that in the US post the payroll data on Friday night. We saw a bit of a move, a backwards move, if you like, in rate cut expectations. Exactly the same thing here. In fact, a bigger move in Australia. Look at the long end there. So we're sort of looking down towards maybe 3.1 by the end of next year. We're now looking at kind of 3.5, 3.6 by the end of next year. So that's a big move in a month. And most of that move has happened in the past 24, 48 hours. So that's a much more hawkish stance from the RBA that the market's now pricing in. The dollar should be rallying on this because this is higher Aussie rates, lower US rates. But the China thing's sort of weighing on the currency. So the currency is actually selling off, even though people have taken the assessment of the economic data, maybe not so much the minutes, but certainly the consumer confidence data out today, the business confidence data out today. And my reading of what the Reserve Bank minutes said were the economy is quite robust. We're seeing consumer spending bounce back. We're seeing these tax cuts come through. So we're seeing quite a lot of upward momentum, or at least stability in the Australian economy, which means the RBA doesn't need to cut rates.
Yeah, I think I was just taken by that one line that basically said that, they had considered the cut, which Michelle Bullock did allude to briefly in the press conference but wasn't really honing in on that. When you look at the consumer confidence, though, wouldn't you say that the reason that is rising is because people are hoping or thinking that there is a cut around the corner? Yeah.
There's a little bit of that, I suppose, reverse feedback loop, isn't there? So the government's probably the RBA is probably looking at that consumer confidence and taking it with a big pinch of salt, because the other thing is that consumer confidence has been in the toilet for a long time. In fact, recessionary levels of consumer confidence, and a lot of economists have been predicting this collapse in consumer spending because look how bearish everybody is. But I think the reality is we're improving from a very, very pessimistic point of view, and it's just this better than feared thing. The economy is better than feared. Consumer sentiment is improving because it was so low and things haven't got worse. Like the RBA stopped hiking rates. They're now talking about cutting them. The futures market's pricing in. So people are kind of saying, well, if I can survive this long, there's some light at the end of the tunnel. Maybe my mortgage rates are coming down. I'm getting a bit of government support on the fuel bills. Petrol prices have come down. So people are starting to see a bit of light at the end of the tunnel. They're still not like optimistic. It's still a negative consumer sentiment read. It's just not as bad as it was.
Yeah. Well, let's talk about the US economy, because I think there's also repricing here in terms of, I don't think we're going to see another jumbo cut at least. How much as well does what you're seeing with the hurricanes, with the dock strike, which has now sort of been resolved, and the oil price kind of potentially push up inflationary pressures as well?
Yeah, that's a tough one. I think if you take shelter out of US inflation, it looks like they've slayed the dragon. Shelter's kind of really sticky because of the way they measure it. They only measure rentals that roll over and houses that sell. They don't measure the rest of the market. So it's really sticky. So I think the market still have view they've slayed the dragon. The question is now is that labour number in particular on Friday, and to a lesser extent things like strikes and commodity price inflation here and there, they're less of an issue. I think the view now is that they just don't need to rush. And in fact, I heard someone on the weekend saying the 50-point cut was a mistake. They're going to look back at it like 2 weeks later and say that was a mistake. We didn't need to do that. But I think what the market's clearly shifted to is we're just going to see 25s. We're going to see a whole bunch of 25s. It's going to be it's probably less about the size of the move. It's now just all about sequencing and timing.
Yeah.
So we've got 2 meetings. We've got one November, one December. We'll see 25 cuts in each. Whereas people were saying another 50 or maybe 2 50s, and that's just completely off the cards. So again, as similar to Australia, but not the same magnitude, is that rate cut expectations have been pushed out, and the terminal rate now is not below 3. It's more like 3.5. So again, quite a big shift in a short period of time on one number. I mean, markets are so fickle, aren't we? We get one data point and we just completely change our view on interest rates.
Yeah, I know. Very fickle. Well, speaking of, anything on your radar, because there has been nothing much happening today, but I guess we had big moves in Pro Medicus yesterday, the Arcadium Rio story as well.
Yeah, that's an interesting one. The commodity price, at least one corporate ringing the bell on the bottom of the lithium market. And, as one of our analysts was saying in the morning meeting, we've had Newmont buy Newcrest, we've had Alcoa buy Alumina, we've had BHP try to buy Anglo, we've now got Rio buying Arcadium. These are big M&A deals. And I think for some longer term investors, they're kind of saying, look, there's been a bit of a pullback in some of these prices, and lithium's like a really rags to riches and back to rags again story, rooster to feather duster and back again, right? I think there's some real long-term lessons for investors to say, when you see big corporates like Newmont, they've had, they demerged Newcrest in the 1960s and they've bought it back now. These are long-term value players stepping into the market. So I think resources looks really interesting.
All right, Martin, always a pleasure. Thank you so much.
Thanks, Juliet.
Mutton Crab from Shaw & Partners. I mentioned there that we had been following as well the big move that we saw in Pro Medicus, particularly yesterday when it hit a record. Rudy Filipek and from FN Arena, and Philip Pepe from Shaw & Partners joined Nadine as they discuss the stock of the day on the call.
The best strategy is, if you really want to get on board of these companies, you don't chase them when they are rallying, because that's more of a trader's thing, but you keep your eyes open, you keep them on your radar, and there will always something somewhere at some point. Bond yields, economic data, market rotation, whatever. There will always be a reason at some point why those share prices retreat. And in that case, you snap them up and add them to your portfolio.
Analysts will call it expensive based on valuations as far as they can see, and then you get an announcement like yesterday, which is probably better than what most people expected. So I can't believe I'm going to say this. Put the valuation aside. It is expensive. It is not a buy. There's probably catalyst rich more. There's renewals coming, which means the share price will keep getting shunted upwards. It's not likely to go down anytime soon. I can't bring myself to call it a buy, so I'll call it a hold. Bottom draw stock, close your eyes, forget about 10 brokers calling you, telling you to sell it.
All right, let's have a look at the market leaders on a day where we did close marginally lower. We talked about West African Resources updating the market after its shares plummeted yesterday, basically saying all is okay at its Burkina Faso mines. Webjet Group looking good, along with Credit Corp, Bellevue Gold and Capricorn Metals to the downside today. Very much the lithium players, the iron ore players. We've mentioned quite a bit about the disappointment, I guess, from further stimulus measures in China. Looking at the smaller end of town, Kinetico Energy had a good session with a gain of 10%, and on the downside in the small end of town today, again, a story of movement in some of those lithium and rare earth players. Okay, tonight, I think there's quite a few Fed members speaking, including Raphael Bostic. You've also got trade balance for August, the NFIB Small Business Optimism Index. Mutton Crab just telling us there how robust the US economy is really showing at the moment, or how much it's showing robustness. Let's have a look at what we're expecting tomorrow. Building activity for the June quarter. A speech from the RBA Assistant Governor Christopher Kent. We heard from Hauser today as well, along with the minutes. And then the RBNZ cash rate decision. Of course, they are already in their easing cycle, and we're going to speak to a few economists from New Zealand tomorrow on that. Let's see where the market has finished the session. A 0.25% loss there. Of course, very choppy in Hong Kong and China. You can really put it whichever way you want. I think one article I read as well was just saying that a lot of that money coming out of Hong Kong has been, as Martin alluded to, the fact that they ran up last week when China was closed, but also perhaps now trying to gain exposure into the A-share market. So you have seen some gains on the Shanghai Comp and the CSI 300, but certainly not the 10% spike that you saw on the open. We'll see what, of course, happens in the afternoon session in China. But for now, for the Australian market, we are done and dusted. We will see you from 9:45 a.m. tomorrow.